For decades, the US dollar has been the undisputed king of global finance. It has served as the default currency for international trade, the anchor for central bank reserves, and the ultimate global safe haven. But is its reign finally coming to an end? In 2026, the chatter about de-dollarization is louder than ever before. Across the globe, major economies, trade blocs, and central banks are actively exploring ways to bypass the dollar. Are we witnessing the beginning of the end for the greenback's long-standing dominance, or is its structural position simply too big to fall? Let's start by looking at the facts. Despite the growing skepticism, the US dollar remains the most dominant currency on the planet, and for good reason. Right now, it accounts for nearly 57% of all official foreign exchange reserves globally. No other currency comes anywhere close to that figure. Beyond reserves, over 85% of all foreign exchange transactions worldwide still involve the dollar on one side of the trade. Why does it maintain such a massive lead? The answer comes down to three key pillars: unprecedented market liquidity, massive economic scale, and long-standing legal stability. As one leading market strategist put it, you can have a negative long-term view on the United States, but if you sell US dollars, you have to buy something else. And the alternatives out there simply aren't very attractive. In times of geopolitical uncertainty or economic distress, investors and foreign governments consistently default back to American capital markets as their primary safe haven. However, the challenges against this dominance are steadily mounting. Public confidence in the long-term stability of Western financial institutions has faced unprecedented stress. Multi-trillion-dollar national deficits, recurring political gridlock in Washington, and growing fears surrounding national debt sustainability are raising uncomfortable questions among foreign investors. Furthermore, the aggressive weaponization of the dollar through unilateral sanctions and asset freezes has sent a strong warning signal to non-aligned nations. Many countries now view heavy reliance on the American banking system as a strategic vulnerability rather than an advantage. The data reflects this gradual shift. Back in 1999, the US dollar represented roughly 71% of global foreign exchange reserves. Today, that share has steadily trickled down to under 57%. Major economies are actively seeking to de-risk their balance sheets. Leading this charge are the expanded BRICS nations, including heavyweights like China, Russia, India, Brazil, and South Africa, who are increasingly settling bilateral trade agreements in their own national currencies while quietly accumulating physical gold at a record pace instead of purchasing U.S. treasuries. So if nations are looking for an alternative who is actually positioned to take the crown, analysts often describe the current global landscape as a TARA situation, meaning there are reluctant alternatives. There is no single contender ready to step up and replace the dollar overnight. Instead, the market is looking at a fractured field of options. First, consider the euro. On paper, it is the strongest institutional competitor backed by a massive, wealthy economy. However, Europe lacks a single unified government bond market, meaning there aren't enough shared liquid safe assets to accommodate the massive capital volume currently parked in U.S. treasuries. Second, we have gold. Gold has emerged as perhaps the biggest winner of this transition. Central banks around the globe are purchasing physical gold bullion at historic levels specifically to insulate themselves against currency debasement and geopolitical sanction risks. It remains the ultimate neutral asset, but it lacks the efficiency needed for daily global commercial trade. Finally, there is the Chinese yuan. While China's global trade footprint is immense, the yuan remains tightly restricted by strict capital controls, limited currency convertibility, and ongoing geopolitical risk. It functions well as a regional trade tool, but it lacks the open capital markets required to serve as the world's primary reserve anchor. So, is the US dollar losing its worth? The most accurate answer is, not overnight, but its absolute monopoly is undeniably loosening. We aren't looking at a sudden financial collapse, but rather a gradual evolution from a single currency global economy toward a more multipolar monetary system. The dollar will remain vital for years to come, but its historical era of unchallenged dominance is facing its greatest test yet. This shifting landscape will fundamentally impact international trade, global inflation, and personal purchasing power. If you want to stay ahead of these macroeconomic shifts, make sure to like, subscribe, and hit the notification bell. Thanks for watching.